Welcome, everyone. Thank you for joining me here tonight. My name is Ashley Murphy. I'm the founder and principal of Arete Wealth Strategists Australia. And tonight I'll be talking about the financial planning considerations for mixed nationality couples. Now, that refers to situations which are very common where you have one spouse who is a US citizen, permanent resident, or through some other set of circumstances satisfies the substantial presence test in the US, and the spouses must therefore be overseas because the spouse has to be a non-US resident. So one's a US tax resident, one is not a US tax resident. That's what we're talking about here tonight. Okay, so just a few disclosures and things to be aware of. This does not constitute personal financial tax or investment advice. That is what I do for my private clients, and I think you'll see tonight is a great example of where it does help to have some advice because it's very complicated making these decisions. I should note, this is actually the fourth presentation this year, but only the second public one. We did a premium webinar in January looking at the comprehensive guide to claiming Social Security from abroad. And that was the donations from that went to the Natural Resources Defense Council. And another premium webinar in March to do with the exit tax and how that's calculated and everything you need to know to be a knowledgeable expat, a globally mobile expat who might be staring down the barrel of this exit tax. The proceeds of that went to the Nature Fund. But in any case, you'll find the February presentation, the comprehensive departure guide for those planning their Australian move. It's on the YouTube channel. Please go check out the YouTube channel. If these are topics of interest to you, then it really helps the channel if you could give us a thumbs up and like and possibly subscribe. And do also note one other thing. If you want to be notified of when recordings are posted, you have to register for the webinar. So I get, without fail, every single time I run a presentation, someone will say, well, how do I get the recording? And it never changes. I say it every single time, just sign up and you'll be notified. So a little bit about me and how I came to be interested in this particular niche. So I'm a tri-citizen raised to an Australian father who was living in the UK. He was a guest lecturer in economics at the University of Sheffield way back in the very, very early 80s, married to an American mother. So that's how it all came to be. Raised in Australia, I moved to the US in 1999, got bitten by the tech bug, moved back to Australia, finished my undergrad studies. And at that time, Australia was really the Wild West in terms of financial planning. There's no way in the world I saw myself as a financial planner coming from a professional background. But that's all changed in Australia. Australia is actually now one of the world's leaders in terms of the regulatory environment that it offers for financial planning. So that's wonderful to see. In any case, it took me a few years. I worked as a corporate financial analyst, very dull job, but learned some extremely valuable skills in doing cash flow modeling that clients enjoy as a skill set today, and allowing me to model out what if scenarios and what happens if this or that or whatever. Anyway, so I founded Arete Wealth Strategists in 2013. It's going to be our 11th anniversary in August of this year. And I'm also the founder of the Global Financial Planning Institute, where we train other financial planners how to work with international cross-border clients. Kinds of situations we assist with, you see here. So an Australian business owner living between the US and Australia. Right now, she's back in Australia, earning a very solid payout, an installment payment from the sale of her business in the US. We're able to get a very favorable results there. So she's actually not taxed on the Australian side on those installment payments because the transaction was presumed to have been consummated in the US. So that was a wonderful outcome there. High net worth Aussie family currently living in the US. Well, actually, this family, they got spooked by COVID and they ended up moving back to Australia, which is where they currently are, but they truly live that cross-border existence, that particular client. And the Aussie executive and family permanently relocated to the US. Well, the word permanent is accurate there. They're still in the US. The kids have all finished college in their late 20s, early 30s. Everyone's getting settled. In fact, the primary client is just entering retirement. So All very good and happy circumstances there. So today, what are we looking at? Before we get into these mixed nationality situations, we have to define many terms, because if we're talking about the pros and cons of this status, then we need to know what are we gaining and what are we giving up. So I'm going to go through, talk very quickly about those key concepts and definitions, arriving at the major decision to be made, which is really as simple as this. You have a once-in-a-lifetime opportunity to bring a non-resident alien spouse, that's the charming term that the US use for someone who's not a US citizen or a permanent resident, to bring that non-resident alien spouse into the US tax system by way of what's called the 6013G election, a once-in-a-lifetime opportunity to opt into the US tax system. Why would you do something as seemingly crazy sounding as that? Because your circumstances may make it make sense. And then lastly, we'll go through strategies to make the most of the mixed nationality status, including gifting of highly appreciated assets to the non-US spouse, asset placement and account titling. Very important. It can really be done effectively with plenty of time to plan, but if you haven't planned and it's crunch time now, then we can see what can be done there. And then lastly, I'm going to round out with a case study just to try and tease out some of the points that have been made here. All right, let's do it. And I apologize, I have a little bit of a cold. I was presenting at a conference at the Investments and Wealth Institute conference last week in Vegas. And unfortunately, what happens in Vegas doesn't stay in Vegas. This cold followed me home. So such is life. So what is a mixed nationality couple? You heard me mention this already. For the purposes of cross-border financial planning, it refers to a couple where one is a US tax resident and the other is not. In almost every instance that I've seen, I've heard of others, but never have I had this before as a client. A mixed nationality couple will always be living outside of the US. Why? I shouldn't say always. Will almost always be living outside the US. Why? Because if the couple is legally in the US, then the non-US citizen spouse is almost certainly a US tax resident if they're there. Simple. Why? Because the US has this physical presence rule known as the substantial presence rule, 183 days with a formula applying to the prior, a certain number of days to the prior year, 1/3 of the days of the prior year, 1/6 of the days of the year prior to that. And if they sum to be more than 183, which I believe the number is in the 120s in the current year, if you were in the US the year beforehand and the year before that, you need only be present in the US for 120 days, and we're approaching the end of April, so that would be coming up very soon for someone in this circumstance. Then you would fulfill that substantial presence test, and by virtue of your mere presence in the US for 183 days in the current year and the formula that applies to the prior 2 years, you would be a US tax resident. So the concept, importantly, that this doesn't really come up as a financial planning concept with other countries. It's somewhat unique to the US. And why is that? Because of the citizenship-based taxation system. So back at the time of the Civil War, it was deemed that there would be beneficiaries who could simply move to the nearby, to the Caribbean in particular, wait till the war was settled, and then come back and figure out what they were going to do from there on. The US government didn't think that was fair, and they imposed an exit tax, and it's gone through multiple evolutions over the past 180 years or so. But that's how it came about, is due to the citizenship-based taxation system. So key concepts and definitions here. First, we're going to talk a little bit more about that citizenship-based. What's that mean in English? The consequences of being a US tax resident. What are all of there's not too many pros, but there's certainly a list of cons. The tax treatment of non-US citizens, how that would otherwise work. Legal versus tax residency. Remember, there's 3 kinds of residency you need to know if you are a US dual citizen. 1, tax residency, and we've spoken about that already. There's the green card test, and there's the substantial presence test. It's a pretty broad test, and it's easy to get caught up being a tax resident in the US. Second, legal status. Are you on a temporary visa? Are you a permanent resident? Or are you a citizen? And the third category is to do with domicile. And that is for the purposes of estate planning. They look at your domicile or domiciliary intentions. Where do you see yourself being long term? So that's the third definition of residency. And lastly, we'll talk about source of income, which is a fascinating topic to do with who gets the first taxation rights on a given amount of income. So citizenship-based taxation. Most systems, Australia is one. We work on the physical presence basis, and that is if you are physically present. And there's been talk for years now, and I'm sick of talk. I am not someone who gets wrapped around the axle about proposals. Yes, there has been a proposal for years about changing the definition of Australian tax residency, but it hasn't changed. That being the case, we're going to roll with what is the definition today. And that there's a multi-part definition for what constitutes an Australian tax resident, but in most instances, in almost all instances, is are you physically present in the country? And if you're not, well, we're not going to tax you because you're not there, with the exception of what's called Australian property. So that would be things like businesses, trusts, real estate, things that are sourced back to Australia. With the exception of those assets, if you're overseas working and your only income is personal services income through your labor, then Australia is not going to tax you. And that's really the cleanest example. The flip side of that, if you are a US citizen and you are performing personal services in a foreign country, then the US will still assess you for taxation. Now, I use the word assess and not tax, because they won't necessarily tax you a second time. That's where tax treaties have come into effect. And for those other countries, the US has about 70 plus tax treaties. For the other 130 or so countries that don't have tax treaties, the US has a combination of foreign tax credits, foreign earned income exclusion, foreign housing exclusion. There are a number of other mechanisms in the Internal Revenue Code that operate to avoid the double taxation, because as unfair as citizenship-based taxation is, the global workforce that the US has put out there has made enough of a stink about this to say, listen, we really think it's incredibly unfair to pay double taxation on the same income. And so that's largely been remedied. Not perfectly. You'll still come across circumstances when you can pay double tax. And there's many, many, many more circumstances where you'll pay the higher of the two, but that's not double tax. Double tax means you pay foreign country A, their rate, and the US rate as well. Pretty rare, but certainly the higher of the two. Okay, so the citizenship, this worldwide tax net applies to, the dragnet applies to citizens, US legal permanent residents, and anyone who's considered a US tax resident by way of the substantial presence test, no matter where they're living. You could be in Antarctica or Zimbabwe or anywhere in between. If you happen to be one of those three categories, then Uncle Sam has got a mark on you. So what are some of these consequences of being a US tax resident? Well, I love the US. I live here. I'm in Minneapolis, Minnesota, in case anyone's wondering where I'm coming from. I'm back living here after a wonderful 2.5 years in Australia that finished in July of last year. But in any case, there are a whole host of things not to like about being a US citizen, and that really starts with this global taxation system they had. So it's going to force you to file FBAR forms. This is a very simple form, and don't be afraid of it. It really doesn't take much time at all to complete. It's a reporting form. It is different from a tax form. A tax form would be, what was your income made here, etc. Well, we're going to send you a tax bill because of that income. This is not that. This is, I have a bank account in Australia. Here it is. That's it. That's it. That's all you need to do. Now, heavens forbid you don't do that, then some of the stiffest fines that I've ever heard of are going to be in effect. and that is a minimum of $10,000, or for willful non-compliance, such as what hit the Schwarzbaum family of Switzerland. They got hit with a multi-million-dollar fine because it's up to half of the asset value. Complicated circumstance there with Schwarzbaum, but the horror stories are not actually that rare. So being aware of this is going to save you a lot of heartache. Another one is the Form 8938, otherwise known as the FATCA forms. The thresholds for that vary by your tax filing status, by if you're living in the US or not in the US. There's more reporting forms to fill there. PFIX, I've been going on about PFIX for years now. I've got a white paper on it. I will do another webinar on it because it has been a while. Excuse me, but the point of a PFIC is you cannot own a foreign managed investment of any kind, and I mean a managed fund, I mean an ETF, an exchange traded fund, a foreign limited liability company that holds more than 50% of its assets produce passive income, or more than 75% of the assets are, I must have got that wrong. 50% of the assets produce passive income, or 75% of the income is passive in nature. If it satisfies either one of those definitions, and that's a very low bar to meet, then we've seen clients who hold foreign investment properties within a foreign LLC, PFIC, bad news. We've seen individuals trying to apply for one of these golden visa lotteries in Europe, in Portugal, where or Spain for that matter, where they require a certain investment into often it's real estate, but sometimes it's some other kind of investment. That's a PFIC. And a PFICs are very unusual insofar as it's not just the tax that's so bad, it's the reporting itself. There's a requirement that the US government has in its infinite bureaucracy, where they must report the number of hours that a given form takes to complete. And to complete a PFIC, I kid you not, per PFIC, and often clients hold many of these funds. It's not a portfolio, it is one single holding. We're talking about 11 hours of work to complete one form. So if you've got these on your tax return, your tax bill just went through the roof. The long and short of it is that we tell clients, stay away from PFICs as much as possible. I've got a prospective client I'm talking to tomorrow, and lo and behold, I've found a PFIC looking at his brokerage statement. So that's certainly going to come up. You also lose the benefits of a tax treaty in that, for the reason that the US, who really writes all of the tax treaties they engage in. Why? Because you're engaging with Goliath when you're signing a US tax treaty. The US won World War II. Who do you think gets to write the template? It's not going to be Vanuatu. It's not going to be Singapore presenting their template to the US. It's the other way around. And the way that the US does it is they have this particular clause, and they're called the saving clause. And the saving clause says, we're just going to pretend, if you're a US tax resident, that the benefits of this treaty do not apply to you. Treatment of foreign retirement plans. This gets really tricky for folks staying in the US. And I don't think there's going to be just through self-selection and who's going to tune into a webinar like this. There's probably not that many people who would have this apply to them. But if you are a permanent mover to the US, you're going to retire in the US, and you've got a superannuation retirement plan, bad news, because that's going to get taxed by the US, and they don't know how to make sense of it. They look through their Internal Revenue Code. They can't find any mention of these words superannuation. They don't know what it means. And so they tax it in a very nasty way, or one of two ways, and neither of them are very good. And lastly, here is the net investment income tax. This is the 3.8% surtax that came about due to the Affordable Care Act. And so it applies to taxpayers, single taxpayers in excess of $200,000, married filing joint in excess of $250,000, and it's a 3.8 surtax that applies to all investment income, regardless of source, above those levels. Next, treatment of foreign trusts. This is complicated. If you've, we could save this for another time, but basically they don't like them, and they take a very dim view of foreign businesses as well. This quickly goes down a rabbit hole. This is where I need to draw my line in the sand. I am a financial planner. I'm not a CPA. This is what I've learned from my CPAs, friends and mentors and tax attorneys. But there's the CFC rules, controlled foreign corporation rules, where the reporting of that can become a nightmare. So that's yet another thing to be concerned about, and where mixed nationality status comes into it. Because what is everyone thinking here who's on tonight's call? They're thinking, well, wouldn't you just put the CFC in the non-US person's name? And the answer would be correct. You would. You don't want the American tax resident to have to deal with that. Next is the Hart Act. I did a whole 90-minute session on this last month. It went into great detail. So you're going to get hit with an exit tax if you meet one of three conditions. If you've got if your average federal tax bill was over $190,000 over the past 5 years, got to be making pretty good money to have a tax bill as high as that. Second, do you have a global net worth in excess of $2 million? Very easy to meet that, relatively speaking. If you own a home, have some retirement plans, some after-tax accounts, etc., Uncle Sam's coming after you. The third one is state and federal taxes. Have you been compliant with them over the past 5 years? Now, the non-resident alien, they don't have to worry about this, but the US person may, should they choose to leave the US, i.e. relinquish their citizenship. So tax treatment of non-US citizens. Let's run through this. So these are the folks that are not citizens, at least. The first category, the resident alien, this is the term they use for the green card holders. So, and their taxation is essentially the same. There's some differences with regards to gift and estate taxes, and that's about it. I had a client, good old client today. He said, Ash, I've been a green card holder for 5 years. We've now got an opportunity to become citizens, but we're still planning on moving back to Australia in 2028. Should we do it? And after stroking the beard and thinking it through, in his particular in their particular circumstances, it really didn't change anything. I mean, it just didn't. It meant he could vote, and if a very particular circumstance arose where he had to leave the US for more than a year or two, then he could come back without any problems. But he's not planning on doing that. He's going to stay here, work, earn some money, and then move back in about 4 years' time. So I said, you know, it's really not a financial consideration at this point. But you will be, in his case, because as I mentioned, he's been here for 5 years on the green card. So he's going to be a long-term green card holder. Therefore, he'll be dealing, he may be subject to the exit tax regardless. Okay, so there's the resident alien. Now, the non-resident alien situation is somewhat straightforward. So you're automatically considered a non-resident alien unless you are not, right? There's a definition that's hard to fail, right? You are unless you aren't. And the only way you're not is if you meet the substantial presence test or are a green card or citizen. So thus, if you're none of those things, if you're quote unquote just an Aussie, then you're taxed only on the income effectively connected with a US trade or business, or to a limited extent, investment income from other US sources. Capital gains, this is something I derive great pleasure in delivering this message. Capital gains are sourced to your primary tax resident. So if you hold a bunch of NVIDIA and Microsoft and Google and Amazon stock that's all gone through the roof since you moved back to Australia, well, congratulations, you're only going to pay Australian capital gains tax on that because capital gains are sourced to where you are. Dividends, however, if you held preferred shares that were spitting out, 6-7% type dividends, well, that's going to be taxed in the US. But because you're an Australian primary tax resident, you also, if there's a difference, and there would be because the US has a qualified dividend rate of 15%, assuming your income is below a given level. So it's 15%. In Australia, it's really taxed at your ordinary income rate. So that would really not be nearly as beneficial as it would be if you were just in the US with those qualified dividends. So anyway, the point here is you're only taxed if you have no US ties, then you're only taxed on those assets that are effectively connected, the US trade or business or certain other investments. Okay, source of income. Important point here. So source of income is to do with where income is deemed to come from, hence source, the word source. Where income is sourced from determined which country gets first taxing rights. Now, for US tax residents, determining whether any further income tax is owed, that is to a foreign country or the US, depending on where the income is sourced from, depends on a range of factors. So the key thing here, and we're focusing exclusively on Australia, I can talk about certain other countries and will, because it helps make points a bit clearer. The relative tax rate of the US over the source or resident country with regards to Australia in most instances, in almost all instances, is higher. And so because of that, we don't worry too much about the US sourced income, because you just have to, you either don't have to pay it in the case of certain things like Social Security, that's not eligible for Australian taxation, but foreign distributions from foreign retirement accounts, pension accounts, they call them using the British parlance for a retirement account, a pension, which I loathe that word because it's ambiguous. Does it mean a lump sum of cash, or does it mean an income stream? And it means both in the British term. But that's what's in the tax treaty, is the word pension, and you end up paying the higher of the two, essentially, if you're in Australia. And if you're in the US, you've got Australian sourced income. Well, same thing, right? Except Australia got the first bite of the cherry. And your foreign tax credit would mean you don't have any additional income to pay on the US side. So let's use an example here. A mixed nationality couple living in California own an Australian investment property. Now, I really feel bad about using that term, mixed nationality couple living in California, because how is that possible with the definition that I gave earlier about someone being a non-US resident? So we'll just suspend disbelief for a moment on that, because the point is more to define source of income. So they own an Australian investment property. Big mistake, and I've done many webinars and will continue to do them, trying to dissuade as much as I may Australians from owning quote unquote investment property from abroad. The only circumstance that I have seen in 11 years where it has made sense, and even that's made some sense, is the wealthier, globally mobile individual who is going to be back in Australia for months at a time and wants to stay in their place. Otherwise, with the higher rate of taxation that applies to non-residents, with the lack of capital gains discount, i.e. you pay capital gains at the same rate you pay income taxes, which is at the non-resident rates, which starts at 32.5%, plus a host of other state-leveled taxes, like the ghost taxes in Victoria. If you're not renting your place, they'll just deem income for you and tax you on that. I'm sorry, I got out of the presentation momentarily. I wanted to address this question here. Elizabeth, hi Elizabeth. She writes, if you're Australia-based and in pension mode and with your self-managed super fund, investing in US-based instruments that give non-qualified distributions like CEFSs, does the IRS tax at 15%? Okay, so that's a tough one. And when you say closed-end funds, I'm presuming, okay, if you're an Australia-based, yes, okay. If you're Australia-based and in pension mode in your self-managed super fund, investing in US-based instruments, that's extremely esoteric. The only way that I used to know to do that was through ComSec. And then I think they closed that as well. So Maybe interactive brokers could allow that, but to even do that is extremely difficult in the first place. That give non-qualified. Well, if they're investing that give non-qualified distributions, does the IRS tax at 15? No, they wouldn't, because they're by definition it's non-qualified. If it was a qualified dividend, then the US may, but then you'd still owe on the Australian side, or would you? Maybe. Oh, that's an interesting one. That's an interesting. If it's in, okay. That is very interesting. Would you owe anything on the Australian side? Probably not, right? Because you're in pension mode in superannuation. You might have found a loophole, but I kind of don't think it's a loophole. I think it's too clever by half, because why not just invest in Australian stocks that have a much higher dividend yield? I know some closed-end funds have very high dividend yields as well, 6-7%, like preferred funds in the US do. But I would say, why pay 15% when you could pay nothing at all on the Australians? That's just my thinking, and you saw the cogs turning in my head as I went through it. But that's a very, very interesting approach there. Okay, so a mixed nationality couple, they own this property in Australia. Income from this property will be Australian sourced income. Why? Because there's nothing clearer that's Australian sourced than real estate. It's clearly in Australia. Thus, the ATO will get first taxing rights, but as the couple are primary US tax residents, the income will need to be included in the US state and federal tax returns to be assessed for whether any additional taxes owed. Bad news. They're in a state such as the wonderful Minnesota or California or New York that has an income state tax. Big mistake. Why? You get to pay state tax on that as well, because the tax treaties are to do with the federal tax, not the state tax. So not only did you get to pay 32.5% on the first dollar of income on that property, but then you got to pay 9.3% to Governor Newsom as well. There very likely won't be any additional US federal taxes owed on the income, as the Australian rates are so much higher than the US rates, right? Starting at 32.5%. So that is to do with making the point about the source of income. Okie dokie. So I'm just going to clear these questions so I can see when new chats or questions pop up. The major decision. This is what it's all about here, folks. Hold on to your seats. This is what you've come here for tonight. Should you opt a non-US spouse into the US financial system or not? Well, it depends, right? That's what the lawyers like to say. So when to opt into the US financial system or US tax system in general, when a US citizen, well, firstly, we need to know this. The tax status that applies to your American abroad whose spouse has not opted for the 6013G US tax treatment is married filing separate. And what do we know about married filing separate? Well, conveniently, we have it right here in this table over here. It stinks. It's bad news. Came about in the 80s from high-income lawyers that were gaming the tax system by playing games. And so they came up with this married filing separate status, which really is no good. So look at that. The rates at which you're paying these amounts are significantly less than the closer to the single, but that's really not the full story, because look at when the 37% bracket kicks in. It's actually quite low. So 346,876. So that is no good at all. Okay, so the main advantage of opting into the US tax system is for the couple. So the flip side of what I just said is, if the non-resident alien opts in, congratulations, as a couple, your US tax exposure just enjoyed married filing joint rates. And there's a host of circumstances that I'll talk about coming up in a minute where it would make sense to opt the spouse in, and a host of circumstances where it wouldn't. So brackets affect ordinary income, capital gains taxes, net investment income, and credits, amongst a host of other things. To bring the US, let's continue with this. The decision should be taken in light of tax rates in the country they presently live in. So in Australia, is it going to be that much more beneficial? No. However, if you had a couple in Hong Kong, the United Arab Emirates, many of the Caribbean countries, where the tax rates were either no tax at all, or Singapore's another, lower than the US, that's when your primary tax burden is coming from Uncle Sam. And so it would make sense to file married filing joint to get a much better overall tax burden, because your only tax burden in those circumstances, or your primary tax burden, is coming from the US. In Australia, less often, but not never, as you'll see. With a couple lives and where they plan to retire. When I'm talking to a prospective client, I always ask that. I say, where do you see yourself in 2, 5, 10 years and in retirement? Because the answers can surprise. And the planning will affect what those answers are. The relative incomes of the couple, do we have a breadwinner, or do we have a more evenly matched kind of situation? If you have a breadwinner who happens to be the US person and they're living in a foreign country, that could change things. If you've got the orthopedic surgeon or the investment banker or fund manager or Google exec or whatever, who happens to be the American citizen, then it could be a different story if the spouse is earning much less money. Relative wealth holdings, who's got more of the assets, in whose name, and are they low basis assets? Are there significant future tax bills to come once those assets are realized and taxed? Are there future inheritances or other major expected inflows, settlements, payouts, et cetera, et cetera? Just spoke with, today was a busy day of meetings, I might add. Excuse me, but I spoke with another client who just got a $2.2 million payout for some incredible work he did in growing a business. He hit a milestone and he got paid that out. Happens that they're both US, they're both dual citizens. They're splitting their time between the countries, but this could have been an example where if the spouse had relinquished her US citizenship, which would make all the sense in the world to do if they were retired back in Australia, and that is the long-term plan. So had this payout occurred 10 years from now, then, and we knew it was coming. I've only been working with this particular client for a year anyway, but if we had known it was coming years ahead of time, then we could have taken some proactive steps to significantly lower that tax burden. And then personal attitudes towards marital sharing. I don't know why exactly, but in almost all instances, I've got clients where what's yours is mine, and it's, people take a very communitarian, I suppose, view of their assets. But there's certainly other clients out there, particularly on second marriages, I've found, where they like to keep things separate. Okay. So the decision to opt in the non-resident spouse into the US tax system is a once-in-a-lifetime election for both the US and the non-US spouse, even if they divorce and later remarry. So you can opt in and you can opt out, but you then cannot opt in again. That's it, you're done. But once may be all that is necessary, given whatever taxing event is coming up. So effectively, what the non-resident alien spouse is saying is, I am going to subject myself to the Internal Revenue Code and thus US taxation. Why would you do that? To get the married filing joint rates, which, depending on your facts and circumstances, maybe you've got a big payout coming or a low basis asset that's going to get paid out, and it's going to be a much better tax treatment if it's married filing joint, then it might make sense to do that. And you simply attach a statement to your first joint tax return stating that you not only elect to do so, but you're qualified to make the election, and that you've never made it previously. All right. So despite the income tax advantages of the 6013G election, obtaining married filing joint status, such an election still might make sense when one or more of the following circumstances apply to the non-US spouse. Will they relocate to the US in the future? Well, if not, then the 6013G election brings a lifetime of tax filings and complications and headaches and restrictions. And this could be outweighed if the US spouse, I should say, this might be outweighed if the US spouse was the breadwinner, and you could see tens of thousands of dollars of savings. Otherwise, you could, or there was US sourced income where it made sense, yet again, for the married filing joint status. Otherwise, you'd have to say, gosh, this is a real headache to have to deal with all these, 2 tax filings a year. 1 is bad enough. 2 is not pleasant at all. Is the non-US spouse a high income? We just kind of spoke about that for a moment there. Do they reside in a low tax or no tax jurisdiction? Certainly not Australia, although I did hear word that Albanese has brought in lower tax rates to deal with the cost of living crisis. So that will be a welcome reprieve. Not entirely welcome to the economists who look at federal debt levels. This is not exactly, there isn't precisely the headroom in advanced economies to be offering for the tax cuts. And be sure you vote in such a manner. Do not be looking for additional tax cuts, because the piper needs to be paid. And now serious commentators, economists are saying that there could be real instability coming down the pike with the magnitude of the US debt in particular. Okay. What do we have here? Someone's written in with a question. Anonymous writes in, if you sell investment property in both names, can the okay, well, where are you? I can't even answer that if I don't know where you are selling it from, where you are primary tax resident of. If you sell the US investment property in Australia, okay, can the onus of the capital gains fall on the US citizen only? No, I wouldn't think so. I mean, if it's joint, it's joint. It should be split between you. That's a really tough one. So your capital gain, in theory, let's say you've been in Australia for years and your spouse has no US ties at all, they're just a non-resident. So your gain is taxed at as married filing separate rates, and the Aussie's rate is taxed at it's going to be taxed in both. If it's a US property, so it's US sourced, they'd be filing a 1040 NR as a non-resident, and then Australia is going to reach their hand out as well to see if there's a top up that needs to be paid to them, which there probably would be, depending on the magnitude of that gain. Okay, thank you. You're welcome. You're welcome. All right, so getting rid of that so that I can see when another question pops up. Point 4 here. So who holds title to what assets, and what are the capital gains tax implications if they were to be sold? I use this term, and I really hope you know what I mean when I use it, called a low basis asset. A low basis asset means you bought it probably some time ago and it has appreciated significantly in value, and there's this big capital gain sitting right there. When you have that situation, that's when we need to be mindful in whose name it's held. There is a rabbit that can be pulled out of a hat when you're dealing with a mixed nationality couple in the making. And what I mean by that is you've got say an Aussie who's a green card holder or temporary visa holder in the US, married to an American citizen. They're moving back to us. The plans are to move back to Australia. Then, for Pete's sake, put the low basis asset in the Aussie's name, because when they relinquish their US tax status, then they receive a step up in basis to the fair market value on the date they resume Australian tax residency. And thus, if it's only a few months henceforth that they're able to relinquish that green card, then they may have just achieved a big step up in basis. And I've seen this achieved many times for clients, and it's a wonderful thing to see. So given the implications of being brought into the US tax system, this is kind of that question that I was just dealing with a minute ago with the investment property in the US, as well as the costs and difficulty of attributing income to a non-resident spouse. This is exactly that question. Thought and planning needs to go into who holds what asset in what country. So In the prior example, with the person that wrote in, not Ms. or Mr. Anonymous attendee there, my planning ahead of time would have been get that entirely in your name. Big for estate planning purposes, where it's going to drastically simplify that, and also for the tax purposes, even though it'd be married filing separate. What you could do, I would never recommend this because I don't know you and you're not a client, but what one might do hypothetically would be to do a 6013G just for that one time, knowing that you could never do it again. This is one and done. Pretty bold thing to do, but you know, how big is that investment property? If it was tens of millions of dollars, probably isn't. But if it was, then that's the sort of scenario where the tax difference could be significant. It does reach an upper threshold before it levels out, and there is a finite difference. It's not going to go on forever, but it would still be significant. Is the non-US spouse owner of PFIX, a major shareholder in a foreign corporation, the beneficiary of a foreign trust, or the recipient of a significant inheritance? If they are, great, keep them out of the US system, because it's only going to cause problems if they have any of these things in their fact pattern. Bringing them to the US is just going to be a rat's nest. Okay, so strategies to make the most of the mixed nationality status. There's spousal gifting. We love spousal gifting, and asset placement and account title. So two strategies to make use of here would be the lifetime gifting to non-US spouses. You can do 175, or you could in 2023. It's gone up a little bit. I apologize, I didn't update to the 2024 numbers, but it's going to be more than that. You can do an annual gift of 175,000. Now, I mentioned the client earlier today who was asking about should he convert from his green card to citizen. He is a perfect example. We've been working together for a few years, and when they came to me back in 2021, big difference between spouses in terms of net worth. He seemed to own all of the assets. She had very little. He was on the fast track to being considered a covered expat, subject to US exit taxes. We don't like that. So every year, he's been a very generous husband, and he's been gifting $175,000 to the wife. Why? Because now their estates are evening up, and they're much less likely to be considered covered expats. Next is the qualified domestic trust. This really only comes into it in the case of death. So if you're a citizen married to a non-resident, to a permanent resident, not too many people know this unless they're typically in their 60s and really starting to think hard about estate planning. But that the permanent resident does not seamlessly enjoy the full 13. I think it's up to 13.7 million this year in 2024 due to sunset. I should mention December 31st of next year, unless other action is taken, which is very likely will be taken. But in the dysfunctional state of US politics, we won't say anything is certain to happen. But it exists as a way for that permanent resident to benefit from that full lifetime gift exemption. They have to set this up. There's a few hurdles for them to jump through, but they're able to enjoy that benefit. So Q&A, Nancy. Nancy, how you doing? I have my investments in a BCT, a beneficiary controlled trust. Now, that's an interesting one. My question is, how are these assets treated since I am not the trustee of the beneficiary controlled trust? Nancy, we need to bring a tax attorney into the situation. I think that's going to be deemed what's called a non-grantor trust. And that very quickly gets out of the realm of what we're talking about here. That's pretty sophisticated stuff. Presumably you'd want to have a couple million in there for it to make sense in the first place for the annual trustee fees. You're looking at a couple $1,000. They're going to file a tax return. You know, there's some overhead to it. But one thing that's just in that I remember about these is that this is another one of these examples of the difference between a principles-based system and a rules-based system. And I know that you've been listening to me for years. You know that I've spoken about that. So Australia doesn't have much time for this sort of thing. They say, no, wrong. We understand what you're trying to do. You're creating a trust at arm's length. You're saying that it's not yours, but really it is, because you're going to be the beneficiary of it. We're just going to tax it as if you're the beneficiary. So that's what I remember, but I'm not a tax attorney, and I would love for you to get an opinion from someone about that. So that's a curly one, but I like it. It also happens to be a way. This is advanced stuff mentioned last month with the exit tax. That is one of the fancy techniques that you can use to avoid the US exit tax, but you could end up being too clever by half, because the ATO could take a dim view of the taxation of that trust. Granted, it wouldn't have been fully taxed by the US on your way out, so it has that advantage. Okay, let's move on here. So asset placement and account titling. I think this is pretty self-descriptive, meaning if you've got a US citizen and a non-resident alien, then clearly hold the things that are going to get a better tax treatment in the right person's name. Just pay attention to when you're buying a piece of property or opening an account or starting a business. Hold on a minute. Which one of us is a US citizen, and what are the complications going to be? So depending on the CGT rate in effect, the non-US spouse is often better placed from owning I said this a minute ago, low basis capital gain assets, foreign investments that would be taxed as PFICs, because the Australia doesn't certainly want to discourage investment in Australian managed funds, foreign businesses, or foreign trusts. Looks like another Q&A has popped up. Thanks so much. Do you have someone you would recommend speaking with? I will email you. Why don't you email me? I'll put you in touch with Mel Warshaw. I think you'll love him. He's based out of New England, and he's one of my go-to guys for this kind of situation. This is a tricky thing, though, Nancy. I will say, when you have these complex things, the advice costs tend to be rather high. All right, so the case study, Pat and Chris. There's the famous Pat and Chris coming back again here. So Chris, 52, is an Australian citizen, and Pat, 55, is a US citizen, Australian permanent resident. So the first thing, let's pay attention here. We have our non-resident alien. Chris is the non-resident alien. Pat is the US tax resident. They found love later in life and got married 10 years ago. They live in Cairns. Pat is a physician. So he or she here is making the big bucks. And Chris is a lawyer making 200,000. They're planning on staying in Cairns and therefore Australia for the rest of their time, their lives, and retiring, I guess, another 5 years. They have no kids. They own an assortment of investment accounts worth $5 million, some joint, some individual, but notably an italicized, a low basis stock position worth $3 million that Pat has. Oh dear, that immediately says to me, married filing separate rates, high capital gains taxes, no good. They own a house together worth $2 million, which they bought for $1 million of gain. Boom, another one, bad news. The US gives a 250, 500 married filing joint primary residence exemption. Australia gives an unlimited exemption. So we want to see that house held in Chris's name. Retirement accounts worth another $2 million. Pat's IRA is $1.5 million of that amount. That's going to be, well, it's US sourced income for sure. Not going to really provide any benefit that I can tell with a 6013G. Pat will get a US company pension of $60,000, more US sourced income here. And Chris expects to inherit $3 million from her family, and Pat $2 million from his or hers. The decision here is to whether Chris should opt into 6013G tax treatment for them to enjoy married filing joint rates, or let Pat face this awful burden all on their own and pay at married filing separate rates. Let's frame it this way. Are the benefits of married filing joint and including Chris's income forevermore in the US worth what? And I shouldn't say forevermore, because you could still get out of 6013G, but then you could never re-enter after that. Are they worth the benefits of Chris might obtain by staying out of the US tax system? Okay, first things first. So Australia's income tax rates are higher than the US. We all know that. So foreign tax credits cover any US tax assessment. So that's pensions, IRAs. We're not worried. The tax rates are going to be that much higher anyway. So there's really no benefit or upside or downside, sorry, to the 613G. Pat's IRA, sorry, I got ahead of myself. Pat's IRA and pension income we tax in the US, but we tax by Australian anyway. Same deal. So no better or worse. The stock portfolio, this is where things get interesting in the house. I couldn't help myself. I kind of I had to tell as I was reading the facts. The sale of the low basis stock inventory or portfolio will hit hard. Married filing separate is going to hit the 20% federal bracket as low as 276,900. Therefore, we favor 673G. Why? Because you hit 20% at a much higher level. They're going to save at least the 553,850. Let's go back and look at that table for a second here. I'm just going to get out of here. The 553,850. I just want to remind everyone where I'm pulling that number from. This only shows ordinary income tax. All right, one second here, folks. I want to pull up the tax rates from my key financial data sheet, which I never leave home without. And here we are, just coming up on page 1. I'll zoom in for you all so it's not microscopic. Zoom. Let's go to 150%. Okay, these are 2023, so they'll be a little bit better in 2024. So $523,000 or $523.50 apparently is when you move from the 15 to the 20% bracket. So that's what we're seeing there. 523,050. Back to this example here. Okay, I'm going to put it back in full screen mode. So they'll save at least 553,850 minus 276,900. There's the okay. So I'm thinking what this is. The 553,850. That's probably the gain, and minus the total gain. I'm thinking is what that is. Minus 276,900. That's the married filing set. That's now I'm with it. I'm sorry. This is just in. So there's the 20% versus the 15% rate. So there's a 5% spread on that 276,950, which is equal to 13,847, plus 3.8% net investment income tax. So won't be will be less. That'll be about $1,700 on the net investment income tax because it would only apply to $50,000. Alternatively, another idea, it would be Pat could gift the portfolio to Chris using his or her lifetime gift exemption. That's another idea. But that gets tricky, gifting to non-resident alien spouses. Something we'll have to talk about another time. Should they sell their house, they'll enjoy the $500,000 married filing joint primary residence exemption if they have married filing joint, but they'll only get $250 otherwise if it's married filing separate. So therefore that favors 613G. Again, similar kind of savings. So all in all, it would seem that the election would result in a savings of about $30,000. And the way I get that is the 13 here plus the 13,847 here. So we're up to almost $28,000 plus the 16 from the net investment income tax from the two transactions. So right around $30,000 from the portfolio and sale of the house. One needs to make a comparison as to whether the hassles of a lifetime. Remember, I think you can also later give it up. So you could just do this as a one-time thing. are worth the savings. The case would clearly favor 6013G if they were in a lower income tax jurisdiction, say the UAE, for instance, and Pat was a breadwinner. Some questions, which I'll address in one moment, but if you're interested in finding out more or perhaps organizing an introductory call, just come to my website. It's Arete, as you see right here. That's Greek. People ask me all the time, they're like, why did you call your business something no one can pronounce? Well, it comes from Aristotle. It means excellence of character, virtue, things like that. It also is French for not stop, as some people think, which is double R. But Arete refers to a rugged mountain ridgeline, and hence the logo there. And just click on Get Started here. If you want to download that key financial data sheet, go to the Knowledge Center. I apologize, my marketing guy wasn't working late, so I couldn't get a cute little graphic made. But next month's webinar is going to be quite a change of pace. We're talking about the taxation of equity-based compensation across borders. Apparently, that's been one of the most read articles that we have. So question and answers, let's get into it. Elise, hi. Oh, sorry, Alyssa. What if the Australian citizen also has US citizenship? Well, not a mixed nationality couple. As I was mentioning at the start, that fails that definition. Next, Elizabeth, again, complicated question. Sorry, can the US citizens sell off US shares in US citizens' name only and gift to Australian spouse? We're in Australia to avoid CGT on sale of shares. Does the same 175,000 rule apply, or is this for US residents only? I'm going to have to read that a second and third time. Complicated question. Can the US citizens sell off US shares? Okay, so they're held in their name only. Yep. And gift to Australian spouse. You're in Australia to avoid CGT. I actually think you could, but I don't know if it's beneficial. I think you could do what you're describing, but let's walk through this. Your partner is going to get hit with the higher of the Australian or US taxes. So let's say they get, I don't know how much this lot is that you're selling, but let's say it's either 15 or 20%. Doesn't matter. It doesn't matter because if it's a significant capital gain, then the highest rate that you're going to pay in Australia is 22.5%, half of 45%. So it's one of these things where it doesn't produce any benefit. So if it's in your name, I could see a benefit if your partner gifted half of the position. That could make some sense because Australia, as we all know, doesn't have tax filing statuses. So you would get a slightly better tax treatment if you were to do that, I could see. But as I always say, I'm not advising you. I don't know your facts and circumstances. I'm just musing through these hypotheticals. Let me see. Anyone chat in anything? No. Any other questions, concerns, or doubtful points? We're now 4 minutes over here. Oh, there is another one. Yep, you're welcome, Elizabeth. That I will say is a wrap. Thanks, everyone. I hope you can make it to next month's presentation. And please do me a favor, if what I've said here is of any relevance to you, then just don't keep me a secret. That's all. Let folks know this is out there. We run them every month, and we do topics that we think will be interesting to people. And as you can see, it is very, very heavily biased towards education. All right. Thanks so much. Thanks, Antonia. See you Monday. Lord Duarte. Hopefully, I'm crossing my fingers. Or I'm sure you've got some other great recommendation.